So how do you keep liquidity and still invest in real estate? So do you want to invest in real estate without tying up all your cash? Here's how investors stay liquid and still build their wealth through real estate. Have you ever felt the conflict of keeping liquid and having your cash available versus investing and locking up your cash in property? I'll show you how the wealthy do it both at the same time. By the end of this video, you'll understand how to stay liquid and still invest in real estate. We're going to focus on structuring your portfolio for flexibility, income, and taking advantage of opportunities. So what's the number one complaint for real estate? Well, it is illiquid, meaning it's a cash-heavy business and it can be hard to exit assets. Real estate's a powerful wealth-building tool, but it can tie up capital for years, if not a decade. You can't always sell fast, and if you have to, you're probably going to have to take a big hit on the valuation. That's why smart investors plan in a parallel fashion for liquidity and investment allocation. I like to focus on the barbell strategy. On one half, you have illiquid long-term growth assets, and on the other half, you have that liquidity available to take down any opportunity. So the first step is keeping a portion of your capital in highly liquid assets. What does this look like? Well, it's cash, it's short-term treasuries, it's money market funds. It can even be stocks or equities. And the other half is going to be allocating those funds into long-term cash-flowing assets. Mobile home parks, self-storage facilities, small bay industrial, apartments. This gives you the best of both worlds. You have the liquidity for opportunities or emergencies that may come up, and you also have that consistent monthly income that continues to serve your lifestyle. So one option in investing in real estate is shorter term syndications, a 1 to 3 year investment that's a value add, buy, improve, and sell. It's important to understand upfront what the timeline of the real estate investment will be. Now, be cautious because real estate can take a lot more time than expected. But if it is a quick turnaround project, meaning 1 to 2 years, which is still not very liquid, then at least you know up front that that capital could be available in the next 3 years. Typical real estate investments are 5 years and can go as long as 10 plus years. An alternative option is to provide debt. I've looked at many debt funds that can create liquidity within a 30 to 90-day notice that you'd like your capital returned to you. And because the fund is liquid, it can provide that liquidity to you as long as you give them the right notice. Also, short-term loans of 3, 6, up to 12 months can be another option to put the money to work, have a first position mortgage on real estate that's secure, and you can achieve an 8 to 12% annual return based on it being a private money loan to a real estate operator. Now, of course, you want to make sure not to over leverage that property when you're lending, and you want to be aware that if there's problems with the project, there's going to be fees and penalties to the borrower, and it still doesn't guarantee that you'll get liquidity. Another method is talking to your banker, using lines of credit against your current real estate holdings equity. Once you've stabilized a real estate asset, many times you've created more equity. Well, how do you unlock that capital? Well, for me, I've worked with commercial lenders where I've gotten an earnout or the ability to pull a line of credit against the equity on that property. And if it doesn't exceed a 70 or 75% loan to current value, then I can borrow the difference between what I originally borrowed for the asset and up to 75% of the current existing value. This is a powerful tool to unlock that cash that's tied up in equity, allowing you to reinvest those funds in maybe a short-term treasury, paying you 4%, and then also allowing you to pounce on opportunities that you see where otherwise, if you did not have that capital, you couldn't take advantage of the opportunity. And at the same time, you're still cash flowing on both forms of debt, your first mortgage and that additional earnout or the additional second mortgage that you pulled on that property. Keep dry powder for opportunities and emergencies. In the beginning of my career, I did not have the luxury to do that because I was all in. I had no money, so I put all of my eggs in one basket in my properties, yet it left me vulnerable because I had no cash available if there was an emergency or more improvements needed. I suggest not putting 100% of your investable assets in a commercial real estate or any real estate project. A good rule of thumb for me is keep anywhere between 10 and 30% of your total assets in cash. This may sound high for a lot of people, but that pool of assets that is liquid can still be invested in stocks if you are not adverse to the volatility of the stock market. It can be invested in crypto, it can be invested in CDs or treasuries or money market funds. I'm saying liquidity is where you can sell that asset immediately and get that cash in order for you to utilize it in any way that's going to benefit your portfolio. Now, be aware of market corrections. If you're in crypto or in equities, meaning stocks, your portfolio can dramatically decrease up to 10, 20, 30% with any market crash. So if you want to be ultra conservative, keep those funds in the bank in a money market or keep those funds in a short-term treasury so you can get that cash immediately if needed and you're not risking the value of that cash while putting it into an investment vehicle. Yet you're still getting a 4% plus return on that money, which keeps up with the current value of inflation. Staying liquid is critical because you're not missing out on opportunity. It allows you to play the long game where you can utilize leverage or debt and you can maintain control because you have that liquidity to take advantage of opportunities that need to be pounced on quickly. I would say you want to match your liquidity with the stage of life or the quarter of investing that you're currently in. In my book, I talk about there's 4 quarters of investing. In the beginning, the first quarter, you don't even know what you don't know. In the second quarter, you have an understanding of the assets that you feel comfortable with and the strategy you want to execute. In the third quarter, you've already made mistakes. You know how you want to play the game and you start playing at the highest level. In the fourth quarter, you start playing more of a protective defensive position, not needing to take massive risks if you already have a large lead in the game. Early on in your career, you may want less liquidity if you are focused on aggressive growth. Like I said, when I started out, I focused on finding a great real estate opportunity and then going all in. And when I sold, I wanted to make sure I had that next opportunity lined up and I allocated all those funds into the next opportunity. But that allowed me to grow and compound my wealth relatively quickly. It still took 10 plus years, but it also exposed me to some massive risk. And when the financial crash in 2008 occurred, it wiped me out and I had to start over. So I do not suggest this for everyone. Midway through your career, I would focus on cash flow and optionality. Especially if you're playing the real estate game and looking at a lot of deals, you want that optionality to be able to buy when you need to buy. Bringing on partners over time is a critical strategy in real estate, but having the liquidity to at least put the deposit, do the due diligence, tie the deal up is necessary for you to be able to even have the opportunity to bring in partners if you don't have the liquidity available to close on the transaction yourself. And at that midpoint, having that consistent cash flow was critical for me. That way I knew I had the basic bills taken care of and I had that reoccurring income where I wasn't running on the treadmill every single day just trying to chase the next dollar. It gave me that buffer and it bought me time so I could be patient and make great investment decisions. If you're approaching retirement or you already have a lead in the game, I would prioritize cash flow or income and have that liquidity cushion. There's no reason to risk what you already have to get what you don't even need. I read that in The Psychology of Money, the book by Morgan Housel. It's a great book about it where people many times will get caught up trying to grow or build their portfolio when they've already met the goal. There's no sense in risking something you already have to get something you don't even really need. You have the lifestyle, you have the cushion, you have the base of wealth that you want, but yet you get caught up in the ego or the idea that you always have to be growing and building your portfolio at a rapid pace. At that level of the game, it's all about wealth protection and preservation. The liquidity allows you to buffer any storms, and you can still get a good yield on your stocks, your treasuries, or your crypto that you have, and have that liquidity if needed, and then still have the base of real estate as the cash flowing, dependable revenue source month over month. That takes a career to build where that passive income is massive and you can continue to live comfortable lifestyle where the assets are low leverage, there's fixed debt, and it's very dependable because those assets have been fully stabilized and they're able to weather any storm if there are financial market corrections. That's why I like mobile home parks, self-storage, and small bay industrial, because you have diversified streams of income. Many tenants that need your product, that need your location, and they're going to continue to pay. And if you lose one, it doesn't matter. Your basis is low, your debt is low, and the costs or expenses to run the asset is low. So you have that predictability that every single month you're going to get that distribution. Outstanding investors do not go broke because they are illiquid. They plan ahead and they build flexibility into every decision. They invest in real estate and they have the liquid option to be able to use that cash as they see fit. So look at your portfolio and remember the ratio that you want to keep depending on what stage of your investment career you're in. So now that you know how to balance out your liquidity and where you can take advantage of opportunity in real estate, let's look at mobile home parks on why they're such a strong investment option, what to do, what not to do, and all the inside secrets about why mobile home parks have been such a great investment the last 20 years.